Welcome, everyone. Asia-Pacific REITs offer defensive characteristics as the asset class is income-oriented with attractive dividends that are largely consistent. I'm pleased to welcome our next presenters, Hui-Ming Ng, Asia-Pacific REIT Specialist, and Derek Yi, Equity Client Portfolio Manager for Asian Equities. They will discuss the fundamental resilience of the asset class as we move towards a synchronized reopening of economies and the potential impact on REITs in the region. They will also share their insights on the recent environment and the opportunities in the sector. Over to you, Hui-Ming and Derek.
Good morning, everyone. It's a pleasure to be here today.
Great. So to start, over the past 18 months, what we've said is that COVID was and still is a fluid situation, and it has played out accordingly. So we've seen start-stop measures in different territories across Asia, but it feels like things have improved in just the past 4 months. So would you be able to share with us kind of the things that you're seeing, the things that have changed, and what the potential impact it has on the REIT sector?
Thanks, Derek. It's good to be able to connect and touch base with investors again before we wrap up the year 2021. If we look back to the last 5 months or 4 months since we last spoke to you, performance for the Asia REITs has been, I would say, flattish, as we saw some speed bumps coming up with the resurgence of Delta-related virus infection cases across Asia. To our disappointment, we saw renewed months of lockdowns again in Australia, New South Wales, and Victoria states. Singapore also went into a new stabilizing phase, which actually meant that we are now back to 100% work from home basis, and social gathering and dining groups has been restricted to a group of 2 from 5, which we enjoyed at the start of the year. While Singapore has turned to move to treat COVID as being an endemic situation, the daily high infection cases has forced the government to still introduce some measures to help reduce the burden on the healthcare system. On the brighter side in Asia, Hong Kong has actually contained the situation very well thanks to the very tight borders control. We have seen tenant sales in Hong Kong recovering very well and healthy, and this was further boosted by the consumption vouchers that were issued by the Hong Kong government from the second half of this year. Despite all these disruptions and frustrations with start-stop measures that we have seen, in recent months in Singapore, we have actually anecdotally seen that tenant sales in suburban malls were not very affected materially this time round. We believe the high vaccination rate of almost 95% on the Singapore adult population is very important, as it has made people less fearful of the virus and people are resuming lives as normal as possible. It also helps in sentiments that it's estimated that over 98% of the recent infection cases in Singapore are only seeing very mild or even no symptoms.
Even though we're seeing a different pace of recovery and reopening for different geographies, it sounds like we're looking ahead. And given the different measures that were mentioned earlier, can you give us your thoughts on what potential implications there may be for rental reversions going forward?
We have earlier shared and speak on that we expect rental support measures and reliefs to go down materially this year, and this has indeed panned out, and rental reliefs remain very well contained versus last year's experience. We saw Singapore and Hong Kong retail landlords guiding for stabilization in their rental reversion trends, with possible improvement going into 2022. In fact, one of the bellwether necessity mall operator in Hong Kong recently reported that the rental reversions has turned positive again on the back of very healthy tenant sales recovery, and occupancy costs on their malls has actually gone down to healthy levels. On the real estate front, global industry warehousing sector continues to stand out in terms of low vacancy rate and strong demand. The recent supply chain disruptions have continued to drive very strong warehousing requirements, and as such, capital values have continued to see appreciation the last 6 months due to the strong demand for this asset class. With the tight vacancy rates that we are seeing across key developed markets and even markets like Australia, rental rates are improving on a quarter-on-quarter basis and further enhancing the investment attributes for more capital allocation into this sector.
Great. That's extremely great insights. So when we're looking and thinking about the fundamental resilience of REITs, I think this is one of the key reasons why we've seen outperformance recently of the asset class relative to other classes, especially given the heightened volatility, defensive characteristics, and kind of, I guess, investors really looking ahead. So, if we're looking at the third quarter, when we did see quite a bit of volatility in the markets, REITs were able to outperform. So does this mean that we can expect to see a continued recovery in dividend income?
As we look into 2022, we believe there are reasons to be optimistic on further dividends recovery for Asia REITs, given that economic risks as well as disruptions from the pandemic is likely to fade with high global vaccination rate by the middle of next year. Compared to a year ago, governments also have more solutions around to fight the pandemic. We have booster programs being rolled out in Singapore. Close to 20% of the adult population has their boosters jab already. We have effective antiviral drugs coming out to the market next year. And we are also seeing rolling out of vaccination for the children in key developed markets from next year. Key countries like Singapore and Australia have achieved very high vaccination rates and have already started to reopen borders from the fourth quarter of this year. Hong Kong vaccination rate, however, is comparatively lower and actually much lower among the elderly. And this is expected to slow down the reopening potential of Hong Kong, and they only are expected to relax borders control maybe from the middle of 2022. But domestically, Hong Kong people are actually enjoying a lot more mobility freedom now, given the very well-contained COVID situation. And Hong Kong government is in talks to open borders to China first, preferably, hopefully in the next few months.
So we understand that dividend income is an important part of investing in REITs. And we've seen some uncertainty to that income since the beginning of the pandemic. The question is, so is the recovery in dividend income going to depend on the recovery from COVID-19?
We have shared previously that dividend returns remains the important investment feature for Asia REITs. This has not changed. In times of market drawdowns, we have seen that dividends have helped to compensate for the share price losses. And in times when market move higher, the dividends have helped to augment the total returns profile on Asia REITs. Over the past 10 years, we have shared previously that dividend returns on Asia REITs has made up almost 50% of total returns. Even in the worst of the pandemic in 2020, dividend returns from Asia REITs were still positive for shareholders. This was actually largely underpinned by high rental collection rates for key sectors like office and industrial REITs, which continue to enjoy high rental collection rates. We saw 2021 being a recovery year for dividends, and this is expected to sustain into 2022 as rent relief further drops off. Occupancy rates can improve in a better economic environment. And of course, contributions from the active M&A done, especially from the industrial REITs space, will further add to dividends in the next year.
Right. So to highlight your point, Hui Min, as we're closing out 2021, given the improvement, we did see, at least on an index level, dividends, the recovery from the lows in October 20, up about 20%. But that's continuing, you're saying, or we expect that to continue into 2022. And as we can see here on this chart, dividends for 2022, or at least the expectations, are up about 16-17% from the low. But one thing is that these levels, these expectations are actually higher than pre-COVID. So, it does look like and sound like the fundamental resilience, the fundamentals of REITs are really coming through. So then aside from this dividend recovery in 2022, what are some of the other, drivers that you're seeing for the REIT sector?
It is interesting to note that despite lockdowns as well as higher interest rate concerns, the activity level for transactions in Asia commercial real estate space continue to be quite healthy. We have seen good quality real estate space across Asia continue to be well bidded by private funds. In recent months, there were early signs of deals being done on even challenging Australia retail malls. If you look at the public capital markets, has also been very supportive for Asia REITs. We have new IPOs that were launched in the last 12 months in markets like Australia and Philippines. And we believe 2022 is going to pan out to be a better year as we are going to see a more synchronized reopening of borders across the world. Even the most tightly controlled China could be looking at potential borders reopening post the Winter Olympics in February next year.
Right. So I guess all in all, what we're seeing within the REIT space is just a pickup in activity throughout 2021 and the expectations that these should continue into 2022. But just to switch gears a little bit, in June, you mentioned that one of the differentiations of this strategy is really capital appreciation. So, given the recent volatility within the Chinese property sector, are we seeing opportunities there? Additionally, are there opportunities outside of China as well?
When the investment teams looks at investment opportunities in the real estate space outside of the Asia REITs for potential alpha or higher returns, we identify structural trends, corporate restructuring potential recovery plays across Asia. Within the Chinese real estate space, our preference is with the Chinese property management companies, given that this sector offers investors a stronger structural story, asset-light business model, and strong earnings growth profile at reasonable valuation. This industry is also well supported by the Chinese government in terms of policy support and has actually much healthier capital management. Most of these companies have low or even zero gearing levels. Despite the recent volatility in their share prices due to macro concerns, the companies that we are invested in are still confident of their earnings growth guidance and growth profile into the next 1 to 2 years. On the structural stories, we see them in the Singapore market, where developers are more actively restructuring their business models to unlock value in their portfolio and to narrow the valuation discounts that they are trading at. Outside Singapore, leading bellwether developers in ASEAN are also very good recovery plays, as these countries exited their recent lockdowns, and most of these developers are actually trading at very attractive valuations versus their pre-COVID days.
Okay. So despite the Chinese property developer sell-off in these property management companies, the operating fundamentals are still different than developers with higher visibility, and also, I guess, importantly, government support. So I also wanted to talk a little bit about, or ask a little bit about inflation. This is one of those topics that I think are on top of investors' minds. And, since speaking to you in June, the inflation discussion really hasn't changed. Have we changed our view on lower for longer? And I think maybe from a different perspective. How has the low interest rate environment supported the fundamentals of REITs or even the growth objectives of REITs?
Indeed, Derek, we have seen the heightened volatility in the share prices of the Asia REITs due to taxation fears, as the recent inflation data has been strong on the back of higher energy prices, supply chain disruptions, and strong post-COVID demand recovery. However, in recent weeks, we have also seen that central banks like the US Federal Reserve, as well as the Reserve Bank of Australia, have pushed back against market expectations of rate hikes in 2022. Central banks continue to reiterate that they will be very patient with rate hikes and focus more on the employment data and wages. Our house view has not changed for lower rates for longer. Lower rates have been supportive of real estate investments, given the comfortable buffer, or we say income pickup, over the cost of borrowings. It has also enabled REITs to make accretive acquisitions over the years, as debt has so far still remained affordable for acquisitions.
Okay. Very, very interesting. So our house view is still lower rates for longer. But, I guess if we're looking more near term, would tapering be a concern? Would that have a fundamental impact on the REIT sector?
Well, we believe every tapering exercise is different and the market reaction will not be the same each time. To put things in context and perspective, the US Fed has actually cut rates to zero and further expanded the balance sheet very aggressively to record levels in response to COVID-19 pandemic last year. As the US economy is recovering well, with the country reopening again, it actually makes prudent sense, in my view, to be withdrawing some of that liquidity. And also this time round, the messaging from the Fed has been much more transparent compared to the 2013 episode. What we can do as a fund management level is we focus back on the fundamentals of Asia REITs. That is, focusing on the core earnings, dividends, and cash flow resilience of the real estate, capital management quality, and more importantly, these REITs must have the quality real estate to be able to command their occupancy rates, the better rental rates, as the global economy continues to recover. We have seen that there's a flight to quality real estate space among the tenants as they expand or they look for new spaces.
Great, thank you very much for the color. So I guess to wrap it up, the fundamental resilience that we witnessed in 2021, we would expect to see continue into 2022. And this is really going to be on the back of a synchronized reopening of economies. The asset class, based on what Hui Min was saying, seems to be one that's growing, which provides really opportunities for investors to gain exposure to really differentiated types of real estate. And with the strategy that we spoke about today, this is really going to provide us the opportunity to seek out some of these, take advantage and seek out these trends. So, I want to thank Hui Min for being with us this morning and sharing your insights into the REIT sector and the REIT asset class. To our audience, thank you very much for sharing your morning with us.